What should you expect for the markets, for the U.S. stock market, global markets, the bond market? What should you expect from your investments over the next decade? I've got that analysis and more coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. Everyone wants to know what's ahead for the stock market. And what is it? Warren Buffett, who said forecasts tell you more about the forecaster than it tells you about the future. And guys, I'm just going to disclaim right now, I'm in that camp. What's the stock market going to do? About 10%. And why do I believe that? Well, that's what it's averaged over the past 100 years. And so will it perform that each and every year? Absolutely not. But over a long period of time, that's what you should expect. And because there are, I've shared this before categorically, if you're investing, you're either a trader, an investor, or a saver. A trader is someone that is working some sort of trading scheme. You might buy an individual stock at 9:45, sell it by 11:30, buy it back at 1, and sell it at 3:30. And you're working some sort of strategy for that, okay? That's a trader, okay? An investor is someone that is investing into the overall markets, a diversified mix. It certainly should have a strategy or a couple different strategies, but they're not looking at it every single day, every week, every month, every quarter. They're looking for the long term, and they understand there's ups and downs, and they're investing in a cyclical basket of investments, so there will be good times and bad, but over the long term, that basket, that mix, those strategies should yield a good reward for the risk that you're taking. So that's an investor. And then a saver is just someone that any ups and downs in the market that the market provides is a little too much volatility. So they're more comfortable exchanging the high reward and potentially higher risk of long-term investing, and they're willing to exchange that for a lower return and lower volatility, more peace of mind. Now, I've shared with you, I'm not telling, hey, one's good, one's bad. I'm an investor, and typically the folks that we work with and serve are investors. The challenge, though, is if you have an identity crisis, and let's take, for example, investors that all of a sudden hear a stock tip, and they think, well, is it a good time to get into Tesla, and then when's a good time to get out? If you're not working an overall strategy, at best, you're going to be lucky. And at worst, it could be a lot worse than that, right? Or if you're a saver, you're thinking, is now a good time to invest in the stock market? And then, things, got bad again. Should I get out real quick? On average, the stock market drops about 14% per year from a high point to a low point. And yet over all of that time, despite that average inter-year decline, it's positive, about every 3 out of 4 years, and by a significant margin well above the years that it's negative. So that's a high level of if you're investing, what category are you in? But regardless, whether you're a trader, an investor, or a saver, if someone claims to know, hey, here's where I believe the stock market's going, you're bound to listen, right? And I am too. I just know no one forecasted the coronavirus, the pandemic. So therefore, if you didn't forecast that, then our forecast's reliable. I will tell you right now, and I don't have the data up on the screen, but the forecasts for what the stock market was going to do this year have almost all been wrong. Of the big names, the big Wall Street firms that, always share their forecast for this year, pretty much everyone was expecting a very low growth or potentially a small decline in the stock market this year. Why? Because we had a decline last year. And so for most people, or for most forecasters, it's just, well, we're going to project a little bit more of the same trajectory. At least by middle of June, we had, surpassed almost all of those expectations. Okay, so forecasts don't tell us much about the future. However, this one caught my attention. And it's put out by Vanguard. It's used in their capital market analysis and assumptions. And essentially, I've seen several of these, or I tend to kind of gravitate towards a few of these because it's based on current valuations, and that's how they extrapolate out and project out what should your expectations be for investments over the long term. Overall, over the next 10 years, Vanguard and this group, they're expecting that U.S. stocks will average between 4 and 6% over the next 10 years, per year, over the next 10 years, well below average. Value will outperform growth. That's what they're expecting. Growth investments, which were awful last year, have been on a tear this year. They're expecting on average to be just 1.5 to 3.5% with an 18% volatility. So lots of risk there. Large cap, small, they expect to be in a similar range. But here's the eye opener. And the Vanguard is not the only one projecting this or forecasting this. International markets, they're expecting, will outperform large, not by a little bit, but by a significant amount. Between 6.5 and 8%, 8.5 average return over the next 10 years from global equities, developed markets, emerging markets, very, very similar. Now, before I get back to the stock portion, because that's more interesting, what's the forecast for bonds? Well, after just an awful year last year in the bond market, at least Vanguard is expecting things to normalize. And who knows? It really depends on inflation, what happens with inflation, what happens with monetary policy over the next 10 years. So personally, I would throw all of this out. They are expecting that U.S. inflation gets back into the 2 to 3% range, and yet somehow their expectation is that U.S. cash will pay out more than inflation, 3.5 to 4.5%. I have no idea how that would even be possible. How is it possible that we would keep interest rates above inflation in a low inflation environment if we do actually get back to that in the future? So to me, I really question how they came up with these numbers on the fixed income or on the bond side. So let's get back to the stocks then. So I don't know if this surprised you. It didn't surprise me, and this is the reason why. If you look back over the previous 25 years or even beyond, right now the forward price to earnings. So the projected price, so the current price of the stock, of the overall, let's just say U.S. stock market or international markets and so on, the price of the stock market compared to the projected earnings, it's high. Guys, it's high. We were at tech bubble type price to earnings ratios coming out of the pandemic after all the money was printed, and obviously after last year things compressed a little bit as the market declined, but now things have quickly kind of spiked back up again. We're not at tech bubble type levels, but it's expensive here in the U.S. And when you compare that to the price to earnings ratio internationally, stocks are much more attractive internationally than they are in the U.S. However, are we actually entering into a time period where stocks will remain at higher PE ratios and we won't see this compression like we saw from the tech bubble until 2008, where forward price to earnings went from sky high to dirt cheap over that time, okay? We will see. But if we do see a similar experience, a lot of folks are forecasting this next 10 years could be similar to that the 10 years following the tech bubble where we had the lost decade in U.S. stocks, then making sure you're diversified is going to be extremely important. Those international investments, which really have underperformed the U.S. markets for the past 10 plus years, those are going to be much more important. Real estate investments, much more important. Small cap and mid cap investments, much more important. A well-rounded diversified portfolio should be much more important if that plays out. All right, so what are the takeaways from this? The first takeaway is no one can predict the future. No one can predict the future. So know who you are, you a trader, an investor, or a saver, and stay in your lane. Second, regardless of who you are, make sure you've got the right strategies. And for long-term investors, that strategy needs to be anchored in diversification, which is, I can't predict the future. Let me hold a good recipe based on analysis and based on historical averages and volatility that hold a diversified portfolio and a strategy that fits with you. Our opinion then is make sure you have diversified strategies, multiple strategies that can complement each other. And then third, make sure that that strategy or whatever your investment strategy is connected to your financial goals, your financial plan, so you're taking the right level of risk for the goals that you're trying to achieve. And then I would argue, no matter if the rest of the year continues to recover or we dip back down because inflation comes back or whatever it is, stick to that long-term plan. You should have an investment strategy and philosophy and approach that plays great offense when things are going great, but also can transition to defense when things aren't as good. It's sort of like a basketball team. You're going to put the top 5 out there or your strategy out there. They're going to play offense when you have the ball. They're going to play defense when you don't have the ball. That's the approach that you need to take, and it all needs to be consistent with the financial goals that you're trying to achieve, your financial plan. Work with your certified financial planner on that. If you don't have a CFP on your team, contact one on my team. Find us online, Korhorn.com. That's Korhorn with K, wisemoneyshow.com. You can find us there as well, or send us an email, info@korhorn.com. All right, there you have it. Go out and take your next wise step in your financial life.